Hello, I am recording this on September 2nd, 2024, as the date is relevant. Some of the information that I'm going to be giving to you is going to be time sensitive, and what I'm going to be going over are the Democratic and Republican tax proposals, those aspects of these proposals that have received bipartisan support, and what you should do as a result of this. The Democratic proposals come down to three different proposals. The first is the American Housing and Economic Mobility Act, which is proposed by Senator Elizabeth Warren and Representative Pramila Jayapal. And it's an attempt to target what they call the wealthiest estates and there are a number of different provisions to this, but what we're specifically talking about is the estate tax provisions. The first and most significant is that there will be a reduction in the exemption for federal estate tax purposes from the current $13.6 million to $3.5 million per individual. And it will also be an increase in the tax rate. So those estates that are over the $3.5 million but under $13 million will be taxed at a 55% rate. Those over $13 million but below $93 million will be taxed at a 60% rate. And those that are going to be over $93 million will be taxed at a 65% rate. And there is a proposed 10% surtax on estates over $1 billion, which would raise the tax rate to 75%. Additionally, a number of the proposals would eliminate what are currently considered to be tried and tested estate planning techniques, such as a grantor retained annuity trust and valuation discounting, which will make a significant impact on a lot of the proposed plans, current or existing plans, and they're going to be essentially going to have to be either rewritten or completely scrapped if this is enacted. The second act is the so-called Ultra-Millionaire Act, which is proposed by Bernie Sanders and Representative Khanna. This would introduce a wealth tax of 2% on wealth over $50 million and 3% on wealth over $1 billion. Additionally, it would be taxing capital gains at ordinary income rates for those earning over $1 million. And this is going to have a significant impact on people who have illiquid assets, such as a family business, artwork, real estate, anything that is difficult to sell a portion of. So, you would be in a situation where you'd have to essentially sell 2 to 3% of those illiquid assets every year in order to meet the tax, which I'm not sure would be possible. In addition to that, if you are going to get that wealth tax and you have to sell it and you are going to have capital gains, it means that you are going to have ordinary income from the result of that sale to meet the wealth tax. The third aspect is the Biden administration's 2025 tax proposal. And that tax proposal would have the income tax rate increased to a 39.6% rate, lowering the estate tax exemption to 3.5% index for inflation. And it would also eliminate the stepped up basis for assets in an estate. So right now, if you die and you have $1 million worth of Apple stock, you would get a new cost basis as of the date of your death. And so you would, if you immediately sold the Apple stock, you would not have any capital gains. This would provide that even though you were going to be taxed on it in your estate, you would still have to pay the capital gains tax on that. Now, this has an impact on people who own stocks and bonds and things of that nature, but it has a much bigger impact on people who own artwork and collectibles and other tangible assets, because the current capital gains structure is that the maximum tax rate for the sale of stocks and bonds, real estate, and things of that nature is 20%. But the capital gains rate for artwork and other collectibles is 28%. So quite a significant difference there. Um, so of all of these three proposals, the biggest impact is going to be the reduction of the federal exemption from the 13.6 million to the 3.5 million. And the reason why this is going to have such an impact is because of the index of, how many people this is going to actually affect. Currently, based on the Federal Reserve Survey of Consumer Finances, of the estimated $138 million or 138 million households in the United States, only 1% has net worth exceeding the $13.6 million exemption. So essentially, only 1% of the people in the United States today are affected by federal estate taxes. Um, However, of the total population of the 138 million households, the ones that have 3.5 million or more is 5%, or you're talking about 6.9 million households in the United States will then be subject to federal estate taxes. Um, so you're essentially, by lowering the exemption, you're going to have a five-fold increase in the impact of the federal estate tax law on individuals. And this is going to mean that not only will you have a lot more in the way of estate taxes, but you are going to have a huge tidal wave of people who are suddenly going to have to do relatively complex estate planning comparisons to what they have to do now to avoid paying federal estate taxes on, particularly when you have a married couple. What you can now have is that a married couple with, say, $4 million would be able to have the assets go from the first to die to the second to die to the children and have no federal estate tax. Now, if you had to go from the first to die to the second to die to the children, you would have a federal estate tax on, because you're now exceeding the 3.5 million. So all of these proposals in theory are to reduce income inequality and fund programs such as housing and things of that nature from those taxing those from substantial wealth. They are, this is not a illegitimate goal. It's just that it will have a disproportionate impact on people farther down the wealth scale than currently what the federal estate tax has. So, what about the Republicans? Currently, the Republican proposals are so-called tax cuts 2.0. This is Representative Kevin Brady and Senator Chuck Grassley have the individual tax cuts that were put together in 2017 made permanent, which is the 13.6 million. The federal estate tax is going to be capped at 40%, and keeping the high maximum income tax rate at 37%. Now, this is in response to the fact that the 2017 changes were temporary. They will extinguish on the 1st of January 2026. The second proposal by Representative Jason Smith and Senator Tim Scott is the so-called Protecting Family and Small Business Tax Cuts, and that would make the 2017 Tax Cuts and Jobs Act permanent, but double the exemption that currently is. And this would be, also opposing any increases in the capital gains tax rates as outlined in the Biden budget. Finally, there's the American Family and Small Business Tax Relief Act by Senator Mitch McConnell and Representative Kevin McCarthy. Focuses on extending the Tax Cut and Jobs Act for the individuals, and they are proposing a permanent repeal of the entire federal estate tax. This could make a significant impact on high value estates, particularly family businesses. So the Republicans, the Democrats are proposing social programs and wealth, equality to justify a change in the tax code. The Republicans are advocating that the tax code, that will sunset in 2026 be made permanent and perhaps extended. Since the United States is the second lowest tax burden of the 80 of the largest economies in the world today, there is a justification for being able to increase the tax burden, according to what the Democrats are saying. I'm not sure that there is necessarily as much of a justification of cutting the taxes, although maintaining the taxes I don't think will make a significant amount of change in the way that the tax structure is being enacted. Finally, there are those things that are seem to have some bipartisan support. This assumes that neither one of the parties has a supermajority being able to pass whatever they would like, or that you have a split Congress like we have today, where one party controls the House and one party controls the Senate. So on those situations, the areas that we have is really going to be a question of public opinion. What is it that they can get the most public support behind? There is obviously a certain populist, tax the rich, which is very appealing. However, there has never been a great deal of support publicly for a substantial increase in the estate tax, particularly when you are going to have situations where you're going to have a five-fold increase in the number of households that are going to be affected by a reduction of the unified credit to $3.5 million. So two areas that I do see that there would be probably some bipartisan support would be an adjustment in the estate tax rates going up from the current 40%. And I think there is also a question on whether or not there should be limitations on the step up in basis of capital gains assets in an estate. However, with things so polarized, it is difficult to see how they would be able to put something together that would get a supermajority in the House and the Senate and be signed by whoever is going to be elected president without a large amount of controversy. So what should you do? Well, right now you should get ready. That means go and review all of your estate planning and see whether or not anything needs to be updated. Because if the tax law changes, it is very likely that the tax law will be retroactive back to January 1, 2025. So you have between now and the end of 2024 to actually make the changes. The second is that you should consider those strategies which are being specifically targeted by mainly the Democratic proposals, which is the grantor retained annuity trusts, the spousal limited access trusts, the use of irrevocable life insurance trusts, the use of gifts, and a number of different If you can have those put in place and made, made irrevocable in 2024, they already have said that they will not do what they call a clawback. In other words, they will not say, um, that made under the prior law is now going to be taxed under this new law, and so that you will be able to consider your options. Whether or not you should pull the trigger on these things, I really think it's going to have to be a decision made after the elections, and there is more of a sense of who controls what and what are going to be the initiatives in Congress. The second thing I would consider is where we have the $13.6 million exemption to make gifts. Now, one of the proposals that was in the American Housing and Economic Mobility Act is that they were going to reduce the amount of gifting that any one person can make to another to $10,000 a year and have the maximum amount per person that you can make as a gift without paying or filing in a gift tax return as $20,000. So that means that you should really consider, if it is financially feasible, of making gifts, particularly to things like a 529 plan for educational expenses, or a another irrevocable trust before the end of the year, if you can afford it. The other is that you should consider setting up, whether or not you should be using so-called charitable remainder or charitable lead trusts, because those are not something which have been targeted for, action under the Democratic or Republican programs, so that a charitable lead trust allows you to sell assets without incurring an immediate capital gains on the sale, and to instead have an annuity that comes out and you'll pay taxes as the annuity comes out. A charitable lead trust provides an annuity to charity, and so affording you a current tax deduction, either estate tax if the remainder goes to your children, or an income tax if the remainder comes back to you. The other is taking a look at life insurance. Many times, irrevocable life insurance trusts are funded by annual gifts, so-called crummy gifts, which, if the amount is exceeding the proposed $20,000 a year limit, you may want to take a look at how you may want to fund those irrevocable life insurance trusts today, or being able to leverage them. So if you keep an eye open on what's going on and take a look at what you currently have and see what things would be affected in either situation. Either the Democrats get some or all of what they would like, or the Republicans get some or all of what they would like. And be ready to take action and have a plan ready so that on November 7th, the day after the elections, you can pull the trigger on actually getting the documents drafted and the assets transferred. It may be that you will want to not necessarily fund these irrevocable trusts immediately with assets such as stock in a company or artwork or real estate. You may want to fund it with a promissory note, which is a different structure. I'd like you to thank you for watching this, and we'll try to be putting together more frequently videos in regards to tax and financial planning. If you have any questions, please feel free to give me a call or contacting me via email. My contact information is in the comments below. Again, thank you for your time, and if you have any questions, please let me know.